Okay. So thank you very much, Yashika and Dipesh and Ankita for organizing this budget session. Of course, we have all the panelists touching upon all the subjects, but I'll just take up a few initial points of the budget from the budget speech of the minister. This is the final budget of 2025. As you know that earlier budget was an interim budget, and the assumption which has been taken in this budget is on the same gross domestic product growth, which is in the range of 6.5% to 7% for financial year 2025. The budget has been inclined to present a detailed roadmap for government's pursuit of Viksit Bharat in line with the strategy uh, set, set out in the interim budget. This budget envisages sustained efforts on the following 9 priorities, which is basically productivity, resilience in agriculture, and agriculture has been most focus of the government during this budget. And most of the priority areas, you will see that the agriculture plays a very important role in terms of agriculture research, natural farming, digital public infrastructure, mission of Atmanirbhar Bharat for pulses and oilseeds. And there are other priority areas like employment, skilling, inclusive human resource development, and manufacturing and services, urban development, which is water supply and sanitation projects, and energy security, infrastructure, innovation, and they're talking about next generation reforms. There is also a focus on employment generation in manufacturing sectors, first timers, skilling, and MSMEs. There is a support to the employers due to the additional employment generation with attached PF benefits. There is a focus of participation of women in the workforce, skilling in collaboration with state governments and industry. There is a new employment linked scheme which has been first time introduced as compared to the production linked schemes. So this time government has more focus on the employment. That's why they have introduced this scheme, and the detailed uh, features of this scheme has itself given in the budget, where they are mentioning about various amounts to be received by the employer and employee on achieving a certain targets and on achieving certain thresholds required for the employment by the government. The rules and regulations for foreign investments and overseas investments are going to be simplified. That's what has been said. Whether it's inbound and outbound investment, there is a focus on this. Space economy aims to be increased by 5 times in the next 10 years, and a venture capital fund of 1,000 crore has been allocated by the government. Highlights of the tax revenues. Uh, Gross tax revenue growth is budgeted to be lower at 10.8%. It is because of the reasons that there has not been much growth in the customs duty and union excise duty, but definitely there is a growth in direct tax as compared to the indirect taxes as compared to the direct taxes. And direct tax growth is budgeted at 12.9% in financial year 2025 as compared to 17% in 2024. With this, I'll just take up my presentation uh, for touching upon some of the direct tax changes, and then Prakash will take over the further part in the direct taxes. Okay, so there are two changes which we have done in various. It is not able to. Are you able to see?
Yes, ma'am.
Okay. The changes in the provision relating to income tax rate, business and profession, capital gains, income from other sources, assessments and TDS and house property and Vivad Se Vishwas scheme. But there are other peripheral changes also, and there are also an impact which is coming from different other acts on the Income Tax Act. What we are going to see here in this budget is mainly that the areas which has not been touched upon for a few years or many years, they have really taken care of, or they have actually touched upon. And I would say it's not positive budget, but at the same time there are implications on the common people who want to pay taxes, but at the same time bringing them into the more and more higher tax brackets or higher tax rates than what they should have done. Let's go to all the direct tax changes one by one. For individuals and actual, there is no change in the tax slab. Exemption limit and surcharge is regular, is whatever was there in the earlier years. New tax regime, which is tax, we call it under section 115 BAC. What they have done, they have increased the slab income and then they have also made some changes with respect to the bringing the I would say bringing the more people into this, and they have made the new tax regime as the primary tax regime in the income tax portal. So whenever anybody is filing it, earlier they were having an option, they still have an option, but new tax regime comes first. And the changes which have been suggested in the budgets are effective from this financial year 2024-25. Up to 3 lakhs, it's nil. 3 lakhs to 7 lakhs, it's 5%. Earlier, it was 3 lakhs to 6 lakhs, 5%, and 6 lakhs to 9 lakhs. They have increased it from 7 lakhs to 10 lakhs, 10%, and 10 lakhs to 12 lakhs, 15%, 12 lakhs to 15 lakhs, 20%. So more or less, the effect is 17,500 is the effect because of this change, and 17,500 is the beneficial, it's a higher amount which has been given in this. And old tax regime remains the same. Standard deduction has been increased under the new tax regime. 50,000 or 75,000. They are encouraging people to follow new tax regime where deductions are generally not allowed except 1 or 2 deductions, which is allowed, like CCD. We talk about pension scheme. So national pension scheme is the one where the employer and employee gets the deduction. In case of employer, it is 10% of basic salary. And in case of employee, it was up to 50,000 rupees, which was claimed in the deduction. Under the new tax regime, the employer portion remains exempted. However, they have increased the 10% limit on the salary to 14%. And this is applicable from this current financial year. Deduction in family pension, it was earlier 15,000, it is increased to 25,000. Okay. This is major change in the business and professional income. Earlier, the partnership, whenever any payment to the partners were made, whether in the form of salary, remuneration, interest, commission, bonus, it was not chargeable to withholding tax, TDS. Now there will be 10% tax on it. And the special section 194T has been added in this budget. Taxability of remuneration, there was a threshold limit for remuneration. There was a limitation of paying remuneration to the working partners of the firm, which is now increased. And the new limit which has been given gives a benefit to the partners to take the remuneration from the partnership firm. With respect to the other provisions or the changes in the business or professional income, any expenditure incurred outside India to settle the proceedings initiated in relation to contravention by the law of relevant country will be allowed as expenses. Special provisions of tax at the rate of 7.5 shall be applicable only to non-resident shipping company as per section 44B, and not the company which is operating cruise line. New section 44BC has been added to tax 20% of the amount received as the carrier of passengers under the head profits and gains. Corporate tax rate on foreign companies reduced from 40% to 35% with effect from 1st April 2025. That means from 2024-25, the tax rate of 35% shall be applicable. Surcharge and cess remains the same. TDS rate similarly will be changed with respect to the balance income or the other income of the foreign companies, which is from 40% to 35%. However, with respect to royalties, technical fees, the withholding tax rate will remain same, that is 20%, which was already changed. And if there is no permanent account number of the foreign companies, so in that case, the separate section is used, but however, that is also 20%. and the foreign companies may still have option to opt for double taxation tax treaties for a beneficial tax rate. With respect to the capital gains, this is one of the major changes in the direct taxes, not much welcomed, but let's see what are the changes. For computing long-term capital gains, holding period of the listed companies shall be 12. Listed companies unit of equity-oriented funds and zero coupon bonds shall be 12 months. For capital assets such as property, land, unlisted security, the holding period shall be 24 months. Similarly, long-term capital gains on capital assets to be taxed at a flat rate of 12.5%. Indexation on long-term capital gain has been done away with. Any sale happen of any assets after 23rd July 2024, that was a budget day, that indexation will not be available. While computing tax on long-term capital gains on the listed shares
Much
or
needed break.
or equity-oriented mutual fund exemption limit increased from rupees 1 lakh to 1,25,000. There are changes in the short-term capital gains also. For computing short-term capital gains, holding period of the listed securities, unit of equity-oriented funds, bonds shall be less than 12 months. For capital assets such as property, land, unlisted security, gold, etc., the holding period shall be less than 24 months. STCG arise on sale of shares on which STT is paid. It is the tax rate on short-term capital gains is proposed to increase from 15% to 20%. STG on other capital items will be at the same rate. Capital gains on unlisted debentures shall be deemed to be short-term capital gain as per Section 50A, irrespective of the period of holding. This is one of the major changes and is affecting the structuring of the company with respect to the amount which they have taken as from in the form of debentures and unlisted bonds. Buyback of shares will be deemed to be a dividend income in the hands of shareholders and shall be taxable as income from other sources. So there are peripheral impact of this, and the clarity has yet to come on this change specifically in the hands of the shareholders, whether it is individuals or company, or whatever buyback of shares is going to happen by the company, it is going to be taxed in the hands of shareholders. So whatever amount will be paid to the shareholders on buyback of shares, that entire amount will get deemed a dividend. And that means the capital gains, whether there will be any capital gains, there will be capital loss, which is going to be, it will be allowed to be set off against other capital gains. If we do the calculation for this, there are many issues which are arising out of it that could be discussed maybe a later point of time. Equity share at the time of offer for sale in the IPO are unlisted on the date of transfer. Since this listing happens a few days after the transfer, in such cases, litigation is arising in the computation of FMB on acquiring the shares is not covered by this. Hence, it is indeterminable and not chargeable to capital gains tax. Accordingly, a new section has been added to provide computation of fair market value of unlisted equity share which are listed subsequent to the date. So there is also changes in case of income from other sources, that is section 56, where we have a section 56 subsection 1 and 7, which says that the amount which was received as share premium or was received from the investors, there was a tax on the portion of amount which was received, which was in excess of a fair market value of shares. That difference was added in the income of the company. It was more than fair market value. This provision has been deleted, and now whatever amount Indian company receives, whether it is at fair market value or higher amount with a share premium, that will not be taxable. A transfer of capital assets by individuals will be exempted. Any transfer of assets as a gift by the company will not be exempted anymore. Section 113 for the taxation under block assessment, all income disclosed under block period shall be chargeable to tax at 60%. With respect to income from house property, income from letting out of residential house or a part of the house by the owner shall be chargeable under the head and not business income. There are, of course, changes in case of TDS and TCS provisions. TDS and TCS provisions corrections of revised return can be filed up to 6 years from the end of the relevant financial. Currently, there was no time limit for revision of TDS returns. For declaring assessee and as a default under TDS, this time limit shall be non-deduction of TDS by this. Including the non-resident taxpayer is reduced to 6 years from the current time limit of 7 years. TDS shall be applicable on interest payment exceeding 10,000 to floating rate saving bonds. TCS of employee to be considered while calculating the total tax liability on the salary payable. So right now, the TCS, which employee was receiving in case of any payments where or remittance which they were making and TCS was applicable on that was not allowed as available as a deduction from the taxable tax liability of the employee. In that case, it will be now applicable from 1st of October 2024. Clarification given for the TDS 194I for transferable property shall be applicable. The total sale consideration in excess of 50 lakhs is payable by buyer to various sellers. So litigation has been there on these issues. Now it will be treated as a limit of 50 lakhs to be considered for each seller and not for the whole of the property value. Lower TDS certificate can apply for TDS on receipts of sale of goods at the rate of 0.1 by any assessee. This will ease the working capital as earlier TCS was 1% and no exemption for lower deduction available to any kind of industry. Budget has also proposed to cover certain luxury goods as may be specified in future for applicability of TCS. So 206 section for purchase value exceeding 10 lakhs per transaction has been added. Currently, only sale of motor vehicles are covered for the same. Interstate on delay in payment of TCS collected to the credit of government increased from 1% to 1.5%. And income on which withholding tax is paid outside India shall be considered as income received. So they have in case of payments to the residents, they have reduced the TDS rate in most of the cases from 5% to 2%, out of which some of the prominent ones are commission, payment of insurance commission, payment in respect of life insurance policy, payment of commission or brokerage, payment of rent by certain individuals, which was at a higher amount and now it is reduced to 2%. Similarly, there is a payment by certain sums by e-commerce operator to e-commerce participants, which is to 0.1% now, to contractors by individuals, 2%. 194F is on payments on account of repurchase of units by mutual funds. This has been omitted. So partners, we have discussed, it's 10%. Buyback is 10%. So while making the buyback proceeds, there will be withholding tax on 10% and it will be deemed dividend income in the hands of the shareholder. When the payment is made to non-residents, we were talking about long-term capital gains to offshore funds. Was 10% is 12.5% now. Similarly, in case of others. So that's it. I think I'll just hand over to Prakash for the subsequent portion of the direct taxes on assessments and Vivad se Vivad. Vishwas, please. Yeah, over to you, Prakash. Prakash, you are on mute.
Thank you, ma'am. And thank you, BRICS Chamber of Commerce, and thank you, the CCI, for giving me an opportunity to deliberate something on the issue of the proposal which is coming into the direct tax proposal in the budget here. Although Madam has already briefed, but my job is to go a bit in detail, and I would like to go in bit detail here. So I will start with the provision which are related to section 28 here, and I will go by section, and something in between, if required. I will try to jump on the assessment issue of the assessment and reassessment and search procedure that is very dear to me, being a litigation lawyer, and other part, because the capital gain has become a mess here right now. So we will also discuss some issue of the capital gain, some issue of the dividend here, how the scope of the dividend has been enlarged in order to understand what is the implication of the dividend here, what is the buyback of the shares, and how the implication is there, not only in the domestic taxation, but also on the international tax. So, am I visible, ma'am?
Yeah, clearly.
Yeah.
Clear. It's very clear. No problems.
Great here. Because as of now, I'm not starting my PPT. I will like to go through the discussion mode itself here. Okay. Let's discuss that part here. Just hold on. First part is that section 28. Section 28 talks about income from the business and profession. There were many cases here where the builders were letting out the property, residential house property, and they were claiming the deduction. They were charging the rental income under the head business and profession here. So there was a lot of disputes that whether the income of letting the house property should be classified under the income from house property, or it should be classified under the income from the business and profession. The builder used to claim that no, that this is my part of the profession. So I have, even though we have rented out the flat, so it will be classified as the income from business and profession here. The law has clarified that if a house property, which has been rented out or letted out by the owner, and this residential house property has been let out, then it will be classified under the head income from house property and not from the business and profession here. So what will be the gain? The revenue will gain here in the terms of two parts here. First of all, the earlier the SSC used to claim the deduction from 3029 to 44, their deduction will not be available, and only the deduction will be available on account of repair, which is not more than 33% of the let out value of the property here, or the rental value of the property. So by this way, the revenue is going to capture that part here. Another going to another part, that was the another is 3614, where the employer used to make the payment on account of pension fund of the employee, and that was restricted to 10% here. Earlier, it was for the central government, it was 14% here, but now the private players has been made in part, and now they will be also can deduct 14% of the salary of the employee, and they can pay to the pension fund under ATC DD, ATCCT, and when they will pay, that will be treated as a contribution by the employee to the pension fund, and they will get the benefit of that part here. Similarly, Madam has already covered the issue of the section 37. We know that section 37 has already been enlarged in the last couple of years, and how the scope of section 37 has been enlarged in order to say that these are the expenses that will not be allowed for the purpose of deduction here. And recently, one more limbs has been added here. I feel that it is a clarificatory amendment, but it has been said that it will be applied from the assessment year 25-26, and that amount, that is if an SSC, if a business and person who is into the business and profession pay some amount to settle any proceeding initiated in relation to contravention under such law, as will be notified by the central government. So if the central government notified any such law, and for the contravention of such law, if any amount is being paid here, then also that amount will not be allowed for the purpose of deduction here. I will cover to the 44B. 44B, there is an amendment 44BBC, which has already been, a new provision has come. Under the new provision, something has been carved out from the 44B. We know that 44B, the family of 44B is for the purpose of non-resident who are paying the tax under the presumptive taxation. So whether it is a 44B, 44BB, 44BAC, or 44BAD, these are the four provisions that is required here. So now the new provision has been added, 44BBC, which talks about the income of a non-resident from the operation of the cruise in India. And if this operation is the income is from the operation of the cruise in India, then there will be presumptive basis on then it will be taxed on the presumptive basis. And this amount will be 20% of the aggregate amount of the receipt that they will be receiving from India. So they have a detail they have given that how they will be computing the 20% here. So on that part, the foreign company will be taxed in India if they are into the cruise business in India. Another important issue is about the 48, about the capital gain. Before coming to the capital gain, I will like to go to the other provision, because the capital gain, the moment we will start the capital gain, it will take a bit longer time here. So let me cover the shorter part first here. And then we will cover the capital gain, because capital gain is one of the important topic that we must cover here. And I will be covering in detail here. There is a good point that they have removed the angel tax under 5627B. The 5627B, there was a lot of issue was there, particularly in the case of the 5627B, where the company issues the share to a shareholder at a rate which is higher than the fair market value. Then this income used to be treated as then the differential used to be treated as the income in the hands of the receiver here. So there was a lot of dispute that about the how, because the lot of startup, although their fair market value was much lesser, but their shares were issued to the shareholder at a higher price here. Then the issue came before the department here that how to resolve this part here. Then they earlier resolved that, okay, those startups which are getting the registration with the DPIT, in that cases, the angel tax will not be applicable. However, there were many litigation on this point here. Ultimately, the good sense has prevailed and the government has dropped the 5627B, and it is a big relief to the startup company here. Now coming to the assessment, I will come to the capital gain later on here. Under the assessment, one more important point is that we know that a person can file the return under section 139. Sometimes it happens that the SSC is not able to file the return and he makes an application under section 1191B. If the SSC makes in the application under 1191B, sorry, and he gets the approval of that part here, then he has to file the return. So the law has already clarified that those return which has been filed in pursuant of the order under section 1192B, that return will be treated as a return under 139. And if that return will be treated as under 139, there will be a separate period for the purpose of the completion of the assessment under that return here. So accordingly, there is a corresponding modification in the section 153A. 139AA is also one of the important part here, because we know that under section 139AA, the history is something else. The history is like this one. Say, government said that you have to disclose your Aadhaar number while taking the PAN number, or you are filing the income tax return here. The issue came before the Supreme Court here that whether this giving the Aadhaar detail in the ITR or in the case of the filing in the case of the PAN number is not the breach of the privacy, and therefore the matter is pending before the Supreme Court here. I feel that it was a Puttaswamy case which was there, and in the Puttaswamy case, this matter has been referred to the 9 judge bench here. Before that, the government has modified that. Now they have said that there is no requirement of giving the Aadhaar detail while you are applying for the PAN number, or there is no requirement of giving the Aadhaar detail in the ITR here. So by this way, the government has said that, so government has rolled back these provisions here. But in the meantime, the government has said that wherever the SSC has obtained the Aadhaar number by citing the enrollment ID of the Aadhaar, they should furnish the Aadhaar detail to the assessing officer so that he can complete the record here. So it is one of the important changes. However, come to subsequently, that is the issue of the assessment. And one issue of the assessment is coming under the 148 here. I will take more time onto this part here because this scheme has become a mess. I will tell you that how it has become a mess here. We know that up to the Finance Act 2020, there was a assessment which was the 4-year period where the department can open any file for the purpose of reassessment up to 4 years, and in some extraordinary cases up to 6 years. And the threshold was 1 lakh rupees, and more than 1 lakh rupees, then it is up to 4 years, and it is more than 1 lakh rupees, then it is up to 6 years. And in some special cases, it was 16 years. The approval authority was something the PCIT. And there was a famous case of the GK and drive shaft, which we used to read in between here, saying that when the AO has the reason to believe, then the reason to believe must be shared with the SSC, and the SSC, based on the reason to believe, if he wants to file an objection, he can file the objection. And if it does, and if the file objection is filed, then the objection should be disposed by way of the speaking order. And once the speaking order has been disposed, then with the speaking order 140, the AO SSC should file the ITR, and that ITR will be assessed under 148. These were the brief procedure that was there. In 2021, there was amendment in the reassessment scheme here, and we know that it 148, 147, 148, 148A, 148, 149, and 150 and 151 came into the statute, and the new provision of the 148A came. The new provision of the 148A has in fact codified the GK and drive shaft. So the common law of the GK and drive shaft has already been codified into the statute here. And this has become the norm that yes, you will first you has the information which suggests that the income chargeable to tax has escaped assessment. Then the you will issue the so-called notice under 148AB, giving some time to the SSC. SSC may file the reply on that part under 148AC. And after that, the AO, based on the approval of the PCIT or the PCCIT, depending upon the 3-year or 10-year period here, then they can issue the under 148AD along with the notice of the 148 here. This issue was under the challenge before the Supreme Court in the case of, in many cases here, including, and one of the famous judgment of the Supreme Court is the Ashish Agrawal. However, after the Ashish Agrawal, there were a lot of litigations, and we are also arguing now. The issue was there whether the department can start the proceeding for the 1314 and 1415 or not. We are still arguing the matter before the Supreme Court, and let's see the matter how it goes on. However, in order to knowing that these are the lot of complexity in the reassessment here, government has modified on the whole scheme of the 148. Now what they are saying that earlier the reassessment period was 3 years, 3 years and 10 years. Now the government says no, I will not do it. I will reduce it to 3 years and 3 months and 5 years and 3 months. Why the 3 months here? If the income escaped assessment is more than, if the income escaped assessment is less than 50 lakh rupees, then it will be 3 years here. Up to 3 years, they have to issue the notice under 148A, 148A1. And once the notice under 148A1 has been issued within the period of 3 years from the end of the assessment year, then you have to file the reply. And after that, within the period of 3 months here, subsequent 3 months, they will be issuing the order under 148AD along with the 148 notice here. So 148A for the purpose of, now there are 2 dates here. One is the 3 years, another is 3 years, 3 months. Another is 5 years and 5 years, 3 months. 3 years for the purpose of the issuance of the notice under 140A for the where the income escape is less than 50 lakh rupees, where the 3 years, 3 months, where the passing of the order under 148AD and issuing the notice under 148. Subsequently, for 5 years, where the income escape is more than 50 lakh rupees and issuance of the notice should be within the period of 5 years. 148A should be 5 years, and the orders should be passed within the 5 years and 3 months. Another major amendment they have done, what they have done, there were a lot of litigation that who should be the sanctioning authority. Now they have made it blanket that only the additional commissioner or additional director or joint commissioner or joint directors will be the approving authority. So no need to go controversy here about the PCIT and PCCIT here. Irrespective of the period, they have said that sanctioning authority will be this part here. Another, however, while doing everything here, in 2020, when the 2021 amendment came, they said that now the search assessment will be taking place under the 147 assessment. So search assessment which used to take place under 153A for the search person and 153C for the purpose of non-search person, they used to be earlier taxed for up to 6 years and 10 years, depending upon the case-to-case basis. Now it was said that it will be taxed under 147. The again 2020 scheme has been rolled up. This one's here, you will say that it has been reversed here, and they are going back on the issue of the block assessment here. And the new chapter 14B has been inserted into the Income Tax Act, which talks about the block assessment here. The procedure of the block assessment is like earlier law. What will happen in this block assessment? There will be one notice and one notice for the qua 6 years here. And in this 6 year, all the undisclosed income of qua 6 year that will be subject to assessment here. So this block assessment is separate than the regular assessment. So regular assessment will be there, but there will be block assessment, and your total income will be including the undisclosed income in the block assessment as well as the regular income into the as per the regular assessment here. So we have to club for each of the years, and there will be, so there is a special law for the purpose of 158 A's that will start from the provision of 158A, and that will go to the chapter 14B. The important part is that once there is a search and seizure part, once the search and requisitions here, they have said that this search and requisition matter cannot be taken before the 144C, means before the DRP. It has to be taken before the CIT appeal itself here. So this order will be appealable before the CIT, not before the DRP as per under 144C. So in the case of the eligible SSC under 144C, they have said that those SSC where their assessment has been made in pursuant of the chapter 14B, those SSC will not be an eligible SSC for the purpose of the 144C, that is the reference to the DRP here. So I've just briefed about the reassessment scheme and other part here. Now coming to the some of the amendment under the transfer pricing. Transfer pricing amendment is like this one's here. Earlier, when the file goes to the TPO is supposed to check the international transaction, and once he has checked the international transaction, he has to determine the ALP, and he has to submit the ALP amount to the AO, which the AO is bound to follow. But during the course of the determination of the ALP determination by the TPO, if it comes out that there are certain international transactions which has been escaped or which has not been reported by the SSC, then the then the TPO was bound to determine those international transactions and do the ALP of also that amount also. Now this has been enlarged to say that for the TPO can do the specified, can go for the specified domestic transaction also. And if he found that certain specified domestic transaction has not been reported here, then he will determine the ALP of such specified domestic transactions. Another amendment is the 94B. We know that 94B is the thin capitalization arising out of the BEPS project here. Under the 94B, what is the part that if it is in the case of the foreign company, or if it is in the foreign company having a PE in India, or having a domestic company which has the subsidiary of a foreign company, they cannot pay the interest which is more than 30% of the EBITDA. However, while doing so, they have excluded the banking business, the company which are into the banking industry here. Now they have excluded also some of the finance company which are registered with the IFSC here. What Nidhi ma'am has already told that about the rationalization of the TDS provision. I will go through some of the TDS provision, how the rationalization has been done. Some of the important provision that I would like to discuss about the TDS part is that 194T. The problem is that there is always enlargement of the TDS family. And under this 194T, what is going to be happen here? That if a partnership firm pays some remuneration to the partners here, or some commission to the partners here, then on those remuneration and commission, he has to deduct the TDS, and this TDS amount is equivalent to 10% of the income tax, 10% of such distributed amount here. The issue will always arise here that whether the distribution to the partner by the partnership firm is the distribution of capital or is the payment of the remuneration here. Generally, the partners are entitled for the purpose of the share in the profit. They are not entitled for the remuneration. So, however, the government, in order to get more taxes here, and in some amount that they have levied the TDS on that part here, and this matter will be an issue of the debate in the coming days here. Madam has covered 197 part here, where some precious 194C is one of the issues here. 194C versus 194J. Now the issue will be there. The government has said that if there is a conflict between 194C and 194J, then the 194J will get the priority. Means if certain transaction is likely to be covered under 194J as well as the 194C, then the 194J will get the precedence and the TDS will be deducted as per the 194J and not as per the 194C here. Similarly, there are other provisions of section 200. I will go into the detail here. Allow me to go to the capital gain. Okay, before the capital gain here, there was some madam in madam instruction that she has told me to cover something about the application which is pending before the Board of Advance ruling. This is the issue that has come before the Board of Advance ruling. What is the issue? I will tell you. Earlier, it was the Authority of Advance ruling, where a person used to file his application. However, after 2017, there was a lot of pending into the Authority of Advance ruling, and the Authority of Advance ruling was get abolished subsequently. And after 3 years a gap, this was the board of the BAR, that is called the Board of Advance ruling, that was constituted. And once the Board of Advance ruling, that all the file has been transferred from the AR to the bar. The issue has raised that since there are more than 6 years or 7 years or 8 years has elapsed, many cases the applicant wants to withdraw their cases here. So they have already clarified that in case any applicant want to withdraw their cases, they should make an application before the bar, that is the Board of Advance ruling. And once the application is made by the bar should pass an order saying that the application is dismissed. Application is dismissed here. So, or being rejected or dismissed as the applicant has withdrawn this application. So, because there will be no adverse ruling against that part here. Otherwise, it will be adverse ruling against the SSC here. So, very cautiously, we should, if we have filed any application before the AR, then we should withdraw our withdraw our application if we are not going to pursue that part here. One important part was, Madam has told me that about the black money here. Black money, there is an important issue that is coming into the black money. Black money, one amendment is that if your black money, how the Black Money came, Black Money Act came in 2016, and many of the Indian resident, or many of the resident, I will tell you, that who came from outside India, who had some ESOP outside India, who has some house property outside India, or who had some bank balance outside India, they were obligated to disclose their amount of foreign asset in the FA schedule of the ITR. In case the SSC has missed to give the detail of the disclosed part in the FA schedule of the ITR, then this amount was considered to be a black money, and on that black money, a higher tax was imposed. There were a lot of litigation was there, saying that this amount, when they have earned outside India, the tax has already been paid outside India. So there should be no taxation on such is income merely because of the non-disclosure into the FA schedule of the ITR. There are various litigation on this point here. Now the government has said that if your foreign asset is not more than 20 lakh rupees and you have not disclosed into the ITR, that will not be considered into the black money here. One more important point is that now he says that earlier section 230 was there, and still that section 230 is there. Section 230 is say that no person domiciled in India can leave the country without certificate from the income tax authority. So what the certificate they wanted? They wanted the income tax clearance certificate, like income tax, wealth tax, gift tax, or expenditure tax. Under this four law, now the black money has been added, and in the black money has added under section 230A. This means the clearance on account of black money is also required by the person who is moving outside India. And that clearance will be required from the income tax department here. So there were certain changes in the prosecution also. Section 276B has been rationalized, which says that if the SSC has paid the TDS amount with the statement, then there will be no prosecution here. Now, coming to the capital gain issue. Capital gain issue, there is one major amendment is that what they have said that they said that dividend, they have enlarged the scope of dividend, and they say that if there is a buyback of the share by a Indian domestic company, then this buyback, which earlier used to be a transfer, or in fact it is also a transfer, then it was used to be taxed in the hands of the company. Now they say that the buyback is a dividend and it will be taxed as a dividend, and for this purpose the section 222F has been given here, and which says that the deemed dividend, the scope of the dividend has been enlarged here. So in fact it is not a dividend, but it, by way of fiction, they have said that it is a dividend. Once it is a dividend here, it is a taxable in the hands of the recipient of the dividend here, and that is the shareholder. What happens if so one part is taxable as a dividend. However, under section 46A says that in case of the buyback, the consideration will be nil. Means what will happen? Although there is a transfer, there is a capital asset, there is a transfer, but the consideration will be nil. Means for this part here, there will be no tax under the section 46A. If there will be no tax under the 46A, it will be taxed under the head dividend under section 56, where the deduction will be allowed under 57, the rest of the as per the law. But when this capital gain will be taxed in the hands of the shareholder as a dividend, the issue will be the problem will be there, that in the case of the international transaction, where the term dividend has not been defined under the treaty, and they have said that those terms which has not been defined into the treaty they will take the definition from the statute, and by way of statute, they are enlarging the scope of the dividend here. So the issue will be there, where a person who used to get the deduction under the capital gain under Article 13.4, they will not get the deduction under Article 13.4 or 13, but they will be subject to the payment of the tax on the gross amount, and depending upon whether it is 20% in the case of the non-treaty condition, it can be a 10% or 5% depending upon the treaty situation. So the issue will be there because it is a my understanding that it is a recharacterization of the income. Earlier, this income which used to be a capital gain, now they are saying that it will be a dividend income here. This story does not end here. Now they says that what they have said that they have said that for the purpose of the capital asset, to determine a capital asset is a long-term capital asset or short-term capital asset, they have said that those shares, those listed shares, will be always be treated as the long-term capital asset if the holding period is more than 12 months. So for the purpose of listed shares and listed equity here or unlisted debentures, they have said that the period will be 12 months. And in the case of the unlisted shares or unlisted or immobile assets here, this will be a 24 months. So there are two period, 12 months and 24 months. So listed securities, unit trust of India or units of equity oriented fund. So for equity oriented fund means those funds which have invested more than 65% in the equities fund here or in the equity capital, then they will be treated as the equity oriented fund and the zero coupon bond here. For them, the period of holding will be the 12 months for the purpose of long term here. And in other cases, like other unlisted units or unit of business trust or business or investment fund, that will be 12 months here. Unlisted share, it will be 24 months. And all other share, it will be 24 months here. The rate has also been triggered here. In the case of the long-term capital gain here, the rate has been brought down from 20% to 12.5%. However, while doing so, they have taken away the indexation part here. So there is no more indexation right now after 23rd of July here. In the case of the short-term capital gain, the rate has been increased from 15% to 20%. So let's see what are the changes that they have made here. Listed share, the period of holding will be 12 months. And if they are more than 12 months, the rate will be 12.5%. Unlisted share, 24 months for the purpose of the long-term capital gain, and it will be rate of 12.5%. Listed debentures, bond, it will be again 12 months and 12.5%. Unlisted debentures, it will be treated as a slab rates here. Units of equity oriented mutual fund, those funds which are equity oriented mutual fund, then again it will be treated at 12 months and 12.5% is the long-term capital gain. Business trust, units of business trust, which are the listed here, and STT has been paid, that will again 12 months and 12.5%. Immobile property, 24 months, and it will be, if it is more than 24 months, then it will be 12.5%. If it is lesser than 24 months, then it will go for the short-term capital gain, and the short-term capital gain will be 20% here. So based on this part here, I have tried to summarize my presentation, but I will be more happy to receive any questions here, and I will like to reply the questions here if the host permits here. I hope that I'm in time, ma'am.
Yes, it's fine, Prakash. Thank you very much, Prakash. It was very good, and I think crispy but very, very clear. So thank you so much for making this presentation. And I'll just hand over to Archana for starting the indirect tax portion. Over to you, Archana.
Thank you so much. Good afternoon to all. First of all, I would like to convey my thanks to BRICS CCI for giving this wonderful opportunity to be presenting over here the latest amendment that has been amended through the finance bill. And so I'll just update you on the certain changes after the enlightening sessions of two pioneers in direct tax. Now let us shift the whole interest to the indirect tax. And I think indirect tax has always been very interesting part. I hope my audience will also agree to the same. Yes or no?
Yes.
Yes. Okay, so I'll just start my presentation. Just give me a moment. I'm not able to share the screen.
I've just given the access.
Okay. But it is not showing. No, I think I will be able to. I hope my screen is visible to all now.
Yeah,
Yes,
clear,
ma'am. Yes.
Archana.
Yeah, thank you. So let's travel through the major GST reforms and amendment that has been introduced. Though the last 53rd GST Council meeting and earlier to that 52nd GST Council meeting, they both were very interesting because certain changes has been incorporated and which were some of them were really helpful for the SSC, and they have really taken into consideration the initial struggle that all we were into when initially on 1st of July 2017 when GST was implemented. So this was first amendment which I would like to highlight over here is really a very important amendment because of the definition of section 9. The wordings were worded in such a manner that one of the ingredient which was an important ingredient for the liquor industry was escaped. So there was a big tussle which was going on in the liquor producing states between the state as well as the center, whether who will be levying the tax on this aspect, whether this ENA, which is used as a major component for the liquor industry for manufacturing the liquor which is suitable for the human consumption, whether it will be falling within the ambit of VAT or it will be falling within the ambit of GST. So we have received certain notices, and even certain notices has been adjudicated also. They had been decided also in the favor of revenue, and they were of the opinion that okay, whatever you have done, supposingly you have paid VAT, though what you do is you can go and ask VAT department to refund your amount and you kindly pay under GST along with the interest and penalty, because this amount or this supply has escaped the taxability under GST. So there was tussle, there were certain high court rulings. Even 52nd GST Council meeting has also clarified that it will be treated as on is basis, and there will be no further there was no inclination from the revenue side also to or from the government side also to bring it under the ambit of GST. The same were decided at the time of 53rd GST Council meeting also, but as they were not notified, the amendment was not done. So the department was not taking those aspect into consideration, and they were still finalizing the order as per their own understanding of the law. So now with this clause 110, the amendment within the definition of section 9, that means levy, the definition of levy has been amended, and they have excluded the ENA or the rectified spirit, which is specifically used for the manufacturing of alcohol liquor for human consumption. So now this has been carved out. So now the exemption has been carved out. So it has been brought out of the ambit of GST, and this clarification has been made. So it was a welcome clarification because it was like, I think, pending since 2018. And finally, this clarification has been confirmed, and now we just really waiting for the notification so that the litigation aspect can come to a full stop, at least on this ground. After that, the next amendment is with respect to clause 11A. That means, section 11A. That means they have broadened the power which was there in the law by which they can exempt or they can include anything where the non-levy will be there, or they can exclude something from the levy aspect. So again, with this, they have said that any amount which they want, any product they want, or any amount of tax which they feel that exemption is required, so that can be done. So it is basically taking into consideration the general trade practice or the relevant practice which is already in existence. So taking into scenarios which are like giving a tussle between the department or the industry. So they are trying to bridge that gap. And with this insertion of this new 11A, they have given that powers, taking into consideration the various aspects, the practices and etc., to give them the power to not to levy the tax on certain supplies. Then the new amendment is with respect to amendment in section 13. The date immediately. So this is again a welcoming amendment. So I'll just give a little background. So this is with respect to the time of supply in respect of supplies where RCM is attracted. So again, there was an ambiguity since 2017-18 because there is a clause, section 31(3)(f), that specifically deals with the provision where we need to issue a self-invoice in respect to those supplies where the supplier is an unregistered, because his supplies are covered under the RCM provision and he is not issuing the invoices. So there was a gap. What should be the time of supply? Because we have seen that nowadays when audits are going on, in case of certain supplies, if RCM levy or RCM payment has been escaped, so then if today I'm going to make that payment, so as per the provision of law, I should be eligible to claim the ITC. But because there was no written provision for the same under GST, so there was a gap between the understanding of the assessee and understanding of the department. So with this amendment, they have bridged this gap, and the amendment which has been made is with respect to clause B, which says the date. There are two clauses. So A says the date of payment as entered in the books of accounts of the recipient, or the date of the payment on which the payment is debited in his bank account, whichever is earlier. That was the time of supply for the reverse charge mechanism invoice date. Now they have made an amendment which says the date immediately following 60 days from the date of issue of invoice or any other document, invoice or any other document in lieu of that invoice by whatever name called, in lieu thereof, by the supplier, in case where invoice is required to be issued by the supplier. So in case the supplier is registered, though his services are falling within the ambit of RCM, but still he is registered, so he will be issuing the invoice. So in that case, 60 days time limit is there. And in case he is an unregistered, so then the next aspect is the date of issue of invoice by the recipient in case where the invoice is to be issued by the recipient. That is the one condition which is falling under section 31 subsection 3 clause F. So this particular amendment is going to deal with those scenarios where I have to issue an invoice for RCM, and so my time of supply will be invoked from the date on which I am issuing the invoice, for which the recipient is only liable to issue the invoice. So now clarity has been provided in section 13 subsection 3 that wherever supplier is required to issue invoice, the time of supply shall be the earlier of clause A or clause B, and wherever the recipient is going to issue the invoice, the time of supply shall be the earlier of clause A or clause C. Clause C, where I will be issuing the invoice myself. So again, this is a welcoming change, because I think many questions with respect to unregistered person where the supplies are attracting RCM has been sorted with this, that when I will be eligible to take the ITC, whether in case I missed and in case I'm issuing an invoice, self-invoice on a later date, still I will be saving on my ITC aspect. So the next amendment is, I think, is the most interesting and the most important amendment in this whole aspect, where the amendment in section 16 has been incorporated. Section 16 subsection 4 is one provision where I think as on date maximum amount of litigations are going around. There are various high court rulings which are against the assessee. There are high court rulings which are, I think they are trying to portray this provision of section 16 subsection 4 from a different angle than what it is written in the provision. Because if we see section 16 subsection 4, though section 16 talks about the eligibility or the condition which are required to be fulfilled before you are able to claim your ITC. So there are certain conditions which are being prescribed under section 16. After those 16 condition, there is another condition that is saying again non-obstante clause, that is section 16 subsection 4, that decides on the timeline. Earlier conditions are the condition which decide your eligibility, whether you are eligible to take the credit or no. Once that eligibility is decided, then 16.4 comes into the picture, which talks about the timeline until which time duration you are allowed to claim that eligible ITC where you have passed the eligibility test of 16 subsection 2. So there the time limit was, earlier it was 30th September, then it was enhanced to 30th November, and now there was High Court judgment also. And now with this amendment, what they have said is that time limit which has been prescribed under section 16 subsection 4, until which you can take the, or you can claim the ITC, that time limit has been decided for 3 financial year, the crucial 3 financial year, which are 2017-18, 18-19, and 19-20, and 2021 also, sorry, 4 financial year, because all the timeline has been considered as one timeline, one date, and that date is 30th day of November 2021. So apparently speaking, 2021 was covered by the normal provision, but 3 years timeline has been enhanced. Though 17-18, the new earlier timeline was March 2019, but that also has been now enhanced to 30th November 2021. So in case you have filed belated return, in case you were not able to claim that particular ITC, but you have claimed in later period, and along with that you have filed your return also belatedly. So there were lots of litigation going on where the department was not allowing that credit to be availed, and they were raising the demand based on the timeline which was prescribed under section 16 subsection 4. There were a lot of things going on, particularly for these 3 years, because many a time amnesty scheme was provided by the department, by the government, and where they have always given a new timeline for all kind of defaulters who has defaulted in filing their returns. And in none of the amnesty scheme provision, they have ever spoken about 16.4. That means the intention of the lawmakers or the intention of the government was to give the benefit despite the timeline provision. But when it comes to the litigation aspect, or when it comes to the audit aspect, that whole timeline or whole gambit of the amnesty scheme notification were read in a different provision. And it was understood that once you have crossed the timeline of section 16 subsection 4, then that particular quantum of ITC which you are availing in the returns that has been filed beyond that timeline should not be allowed to you. So this amendment has really given help to many of the assessees who were fighting these cases and who has stood by their point and who had not submitted the demand as demanded by the department. They would have been benefited, because yes, every coin has 2 sides. So along with this amendment, they have very categorically clarified that in case somebody has already paid this particular quantum of interest and penalty because of this new provision which they have given such benefit, that will not be taken care of. I will be taking that when I will be talking about 128. But here I will just update you that now the timeline for availing of the ITC is extended for 3 financial years, 17-18, 18-19, and 19-20, up to 30th day of November 2021. Now there is another amendment which has been incorporated again in the same section, which talks about there has been instances when the registration has been cancelled or the registration has been suspended. So in those timeline, we are not able to file the returns. So in case that scenario is there, and now the new timeline talks about whenever your cancellation has been revoked, and if you're able to file the returns within those 30 days, then the timeline will be 30 days after the revocation or 30th day of November 2021, whichever is later one. So these two are really a welcome step that has come through this amendment. And I think it will conclude many litigations which are going on at certain levels, many show cause notices which are yet to be decided for these financial year, or many orders which has been passed against the SSC. Now they can take the cognizance of all these benefits and they can avail the benefit that has been awarded by this amendment. So this is one of the, I think, most awaited amendment or most awaited change that the government has incorporated by this amendment. So this is the same. I have just briefed up, and this is the text material. So provision of 73 and 74 has been, freeze till 23-24. That new amendment that is going to be taken place by this amended section 74A, that will be dealt by my co-presenter. So I'm not going on that, but 73 and 74 has a shelf life, and that shelf life will be has been freeze till 23-24 financial year. Section 30, again, there has given certain amendment with respect to the revocation, that there will be revocation of cancellation of the registration will be subject to certain condition and restriction as may be prescribed. So the amendment in the rules, corresponding amendment in the rules will be there to draft or to incorporate those condition or the restriction that may be incorporated for the revocation of the cancellation. Every registered person who is required to deduct TDS under section 51 shall electronically furnish the return every month. And even if he has not made any deduction, but he's liable to make, and in certain months there may be a times where he has not made any deduction, but still with this amendment, now he is required to file those returns on a monthly basis. So earlier there was instances when there was no deduction, they may have missed to file the returns, but here these returns has to be filed. Then there has been an amendment in section 54, that is notwithstanding anything contained in this section, no refund of unutilized input tax credit on account of zero rated supply of goods or IGST supply, that is with payment of tax, will be given to those supplies where export duty is subjected. So there was an anomaly between section 54 subsection 3 and the wordings of section 16. To bridge that anomaly, now they have incorporated this new amendment. Now there will be no refund, neither of ITC nor with payment of taxes, wherever the supplies or the goods are prone to export duty. And now they have used the word zero rated supply. So that means not just the exports, but also the SEZ supplies, because zero rated supply has been defined under section 16. And if we see the provision that has been mentioned under section 54 subsection 3, read with section 54 subsection 8, they are using word exports. So that's why there were ambiguity also when the amendment in section 16 was incorporated, when they have prescribed the class of persons or the class of goods has been prescribed on which the IGST refund will be denied. So that also was taking into consideration only the word exports. So again, there was an anomaly whether how to read that notification, how to read the word export, or to include zero rated supply will be included in that word or no, or zero rated supply will be excluded. So this time they have bridged that gap and they have used the word zero rated supply. So that means your export as well as your SEZ supplies are included in this amendment. I don't know what I should say, whether it is a positive amendment or a neutral amendment or a negative amendment. I don't know. But yes, section 70, the most controversial section of the GST law, which talks about summons. So here now they have said that now even an authorized representative, he is eligible to appear and shall state the truth. That means he is now eligible to make or to tender the statement or to produce documents or any other thing that is required by the learned officer for that particular inquiry which he is undertaking. Earlier also, we used to represent, we used to submit the document, we used to present the case, but yes, for tendering of the statement, they used to call the person or the, director or the owner, whatever they should have deemed fit, they would have called that person only, apart from the authorized representative or a professional who were representing them. But now with this amendment, they have given that power to even the professional also, that they can, as they are their authorized representative, they can go and tender the statement. So I said why I'm saying it is a neutral, or it is, I don't know whether I should saying it positive or no, because I don't know how the onus will be put on now, because any which ways an authorized representative will be providing the details which has been provided to him in his best of capacity and to the best of his knowledge. But how they will be taken into consideration, that's again going to be a challenge. And as time will fold, we will be seeing how come it has been taken out. So this is the amendment which I was talking about, 128A. In the nutshell, what it says for 1718, 1819, 1920, because we know how the GST has unfolded itself and how technical glitches has affected everyone, including both the sides. So for 1718, 1819, and 1920, if you have received a notice or if you have received an order, but both under section 73, that means there should not be any fraud, willful suppression. In that scenario, if you are able to identify the matters and you think that, okay, making the payment of complete amount which has been demanded under the tax liability, if you deposit the same before the cutoff date, which is as of now is 31st March 2025, then whatever levy of penalty and interest that has been levied under those show cause notices or the order will be waived off. That means you don't need to pay the interest and the penalty that has been demanded or alleged in case of a show cause notice or an appeal, but that matter should be pertaining to non-willful suppression matters only. So again, it's a very welcoming change that has been incorporated. So whatever you think that there are ongoing litigation or pending litigation where you can take this benefit, though it has to be notified, we all are waiting for the notification. So from whatever has been under litigation from 1st of July 2017 up to 1920, this benefit has been awarded, and whatever the notice has been issued under section 17 or the order which has been passed under section 107 and 108, there also you can take the benefit. So that means the benefit has been awarded at two layers, one at show cause notice level, and even if the show cause, let's say today also, if some of the show cause pertaining to this period are finalized, then also you still have the benefit of taking this amnesty benefit, because it also covers the order under sections 107 and 108 also. So this is the whole text. The nutshell of this whole text is that your interest and your penalty will be waived off. Then there is another amendment with respect to co-insurer. Again, that was long pending. We have seen many insurance companies have received show cause notice worth a huge quantum. So now they have incorporated two services, those like your reinsurer service and your co-insurer services, as a part of Schedule 3. So that means your insurance sector, because there are two aspects. One is insurance, then one is reinsurance. And in that reinsurance also, there are certain co-insurers and there are certain other aspect under which you, taking into consideration the quantum of the risk, you further reinsure those insurance. And that's the general practice of the insurance industry or the insurance sector. So in all those scenarios, there was a gap between the understanding, or there was a gap between the wordings of the law, whether, as it is a value added tax, so whatever has been done for the furtherance of the business has to be covered under the definition of supply under section 9 or no. So yes, the litigation was long pending litigation, and now with this amendment, when they have incorporated those amendment as a part of the Schedule 3, so it has also clarified certain aspect that yes, this thing has to be taken into consideration accordingly, and they will not be treated as a new supply, and so no tax liability should be incorporated on these aspects. So these were few of the important amendments which I wanted to discuss today. And so this is 16 subsection 4. They have clarified that whatever benefit they have given in case where you don't need to pay interest, or in case you don't pay a penalty, but whatever you have paid, no refund shall be made of all the tax paid or input tax credit reverse which would not have been paid so, or not reverse had section 114 been in force at all material times, because they have enhanced the timeline of section 16 subsection 4. In case you have already made the payment with respect to section 16 subsection 4, taking into consideration the timeline which was prevailing at that point of time, so today you cannot go back and ask for refund. So it is always happening. I mean, whosoever has complied at that point of time, I mean, they will not be getting any further benefit. I mean, they had just bought the piece at that point of time only. And ones who have still litigated those issues, or who are still fighting on those pointers, then they will be getting this benefit. And whatever the benefit has been awarded by these amendment, that will be only taken into consideration by those who are still fighting and who has not made the payment with respect to those alleged demand at that point of time. So this is again amendment which has been brought in section subsection 4 and incorporated subsection 5 in section 16 that we have already discussed with respect to wherever there is a export liability. So they will not be allowed to have a refund, and a class of goods or services or both on zero rated supply of which the supplier may pay IGST and claim refund in accordance to the provision of section 54 subsection 3 and the rules made thereunder. So now they have clarified with respect to the class of goods also and class of person also, and they have used the word zero rated supply because there was an ambiguity, as I given you a background. Earlier they have used the word exports during their amendment which has been notified. Then again a further amendment was notified where they have clarified with respect to SEZ supplies. So now all those things has been taken into consideration, and now they have incorporated the word zero rated supplies, and accordingly the amendment has been taken into consideration. So I'll just see if anything else. So earlier, the supplier who has paid IGST on export of goods like except tobacco or pan masala, because they had already been notified that now there will be no benefit of Rule 96, that is with payment of taxes, you cannot take the benefit of refund, were eligible to claim refund of such IGST paid as per the provision of section 54. However, inadvertently, SEZ supplies were missed to be included in the said provision. So this was the whole background. So now they have taken into consideration that missing of SEZ supply, and they have incorporated zero rated supply. So refund of unutilized ITC cannot be claimed in case of zero rated supply of goods where export duty is there. So now 54 as well as 16 are in sync, where export duty will be leviable. Earlier, this provision was only standing in section 54, and 16 does not warranted the same provision. So this amendment is only clarificatory in nature, wherein the reference to section 54 has been added so that they both are on the same pedestal. So these were the amendments which I just wanted to highlight today, and I'm opening the forum, but I think I'm running short of time. So I'll hand over my podium to Sarthak so that in case we are still left with some time, so we'll be taking the question answers at that point of time. Thank you so much. Over to you.
A very good evening to all the participants and esteemed speakers. Thank you, Nidhi ji, Prakash ji, Archana ji for a wonderful deliberation. Thank you, Dipesh, for the introduction earlier, and thank you to the entire team of BRICS CCI for organizing today's webinar. It's indeed a great pleasure to be here today for discussing the highlights of the Indian Union budget, which was recently presented by the Honorable Finance Minister. So you all must be aware that this budget has introduced several significant changes to the Indian taxation framework, which broadly aims at simplifying the compliances and simultaneously promoting the ease of doing business in India. So, as far as GST is concerned, there have been number of amendments that have been proposed, mostly which have been already discussed in detail by Archana ji. But yes, one important change that I wanted to discuss in today's session is regarding the introduction of a new provision, which is Section 74A, that aims to harmonize a common timeline to undertake adjudication proceedings in the GST law. And such provision shall be made effective from financial year 2024-25 onwards. So, in the before discussing the Section 74A, I'll brief about the current tax structure. So, in the current GST structure, Section 73 and 74 of the CGST Act specifically deals with the provisions of demand and recovery. That is the entire procedure of undertaking adjudication in the GST regime has been provided under Section 73 and 74 of the CGST Act. Section 73 specifically deals with cases other than fraud, willful misstatement, or suppression of facts. In such cases, an order against a show cause notice for a particular financial year is required to be passed within 3 years from the due date of filing of annual return. The penalty in Section 73 cases where there is no allegation of fraud, willful misstatement, or suppression of facts can extend up to 10% of the tax liability or rupees 10,000, whichever is higher. On the other hand, Section 74 of the CGST Act deals with cases involving fraud, willful misstatement, or suppression of facts. In such cases, an order against a show cause notice for a particular financial year is required to be passed within 5 years from the due date of annual return. So, in Section 73, the time limit to pass an order has been prescribed to be 3 years, whereas in Section 74, the prescribed time limit is 5 years. Further, the penalty for cases involving fraud, willful misstatement, or suppression of facts can extend up to 100% of the tax liability or rupees 10,000, whichever is higher. So, in nutshell, Section 73 and 74 provides for separate and distinct procedures, timelines, and levy of penalty for cases involving fraud or suppression and cases where there is no involvement of fraud or suppression of facts. So both of these provisions, that is Section 73 and 74 of the CGST Act, are now being amended by the Finance Bill in order to limit the applicability of these sections for raising demand up to financial year 23-24. Since from financial year 24-25 onwards, demands will have to be adjudicated as per the newly proposed Section 74A. In other words, adjudication proceedings up to financial year 23-24 would be dealt by Section 73 and 74 depending upon the nature of tax evasion. And from financial year 2024-25 onwards, adjudication proceeding would be dealt by the newly proposed Section 74A. So basically, Section 74A is a substitute of Section 73 and 74 with effect from financial year 24-25 and onwards. So, as far as Section 74A is concerned, there are three important points which I felt should be discussed in today's webinar. Firstly, the timelines which have been prescribed for undertaking adjudication proceedings under Section 74A. Secondly, can such timeline be further extended, as we have recently seen that the government had extended timelines for issue of notices and passing of orders pertaining to financial year 17-18, 18-19, and 19-20. Third one, and the most important one, is as to how will penalty be levied under the proposed Section 74A. So the first important point is to know about the time frame which has been prescribed for undertaking adjudication proceedings under the proposed Section 74A. So Section 74A provides for a common limitation period of 42 months for issuing show cause notices, irrespective of whether the charges of fraud, willful misstatement, or suppression of facts are invoked or not in the show cause notice. So, in this regard, it has been specifically provided that a show cause notice issued under Section 74A shall be issued within 42 months from the due date of annual return or 42 months from the date of erroneous refund, as the case may be. So for financial year 24-25, the due date to file the annual return would be 31st December 2025, and therefore show cause notice pertaining to financial year 24-25 can be issued within 42 months from such due date. So the period of 42 months from 31st December 2025 would end on 30th June 2029. That is 42 months from the due date of filing of annual return. So hence, SCN for financial year 24-25 can be issued by the GST authorities maximum by 30th June 2029. So apart from providing a common timeline from issuance of a show cause notice, a common time frame has also been prescribed for issuance of a demand order. In this regard, it has been provided that a demand order under Section 74A shall be issued within 12 months from the date of issuance of SCN. So, as just discussed, for financial year 24-25, SCN can be issued maximum by 30th June 2029, and therefore demand order against such SCN can be issued maximum by 12 months, that is up to 20th June 2030. So, in effect, the limitation period for issuance of demand order under the newly proposed Section 74A has been made uniform as 12 months from the date of issue of show cause notice. So, if you calculate the time limit for issuance of a show cause notice is effectively 3.5 years from the due date of annual return or the date of erroneous refund, as the case may be, and the time limit for passing an order has been notified to be 1 year from the date of issuance of such show cause notice. So, in totality, a period of 4.5 years has been made available with the GST authorities to adjudicate the GST matters, even if show cause notice and demand order is issued on the last date. So, so the newly introduced Section 74A will definitely rule out the complexity in keeping the track of various limitation dates for each financial year, and it will also become an ease in back calculation of the due dates of show cause notices, both from the perspective of taxpayers and the GST authorities. So, as I told you earlier, another important aspect of proposed Section 74A is whether the prescribed timeline of 42 months and 12 months can be further extended. So, as far as the Section 73 and 74 is concerned, there was no specific provision that provided that the time limit to issue a show cause notice and order can be further extended apart from the prescribed timeline. However, it has already been seen for 3 financial years 17-18, 18-19, and 19-20 that the government extended the prescribed time limit under Section 73 by using Section 168A of the CGST Act. So, such provision, that is 168A, provides the power to government to extend timeline on account of force majeure events such as epidemic, flood, cyclone, and various other special events. So already a lot of litigation has already taken place on this issue, and multiple high courts have already upheld the government's decision to extend the time limit under Section 168A. However, as far as the proposed Section 74A is concerned, a specific proviso has been incorporated which specifies that the proper officer can extend the time limit of 6 months. And such a timeline can only be extended with the permission of commissioner or joint commissioner. And it has been specifically provided that the reason for the delay in issuance of demand order shall also be recorded in writing. So that means in total a time period of 18 months from the date of issue of show cause notice would be available with the proper officer to pass an order. So, however, the extension of 6 months is only available for passing an order, but not for issuance of a show cause notice. So, as far as the time limit for issue of show cause notice is concerned, it has been freezed to 42 months, and the same cannot be extended under the proposed Section 74A. unless the government again takes recourse of the powers which have been provided under Section 168A. And apart from that, another important aspect, and the last one is with respect to Section 74A, is that penalty provisions have also been relaxed to a certain extent. So earlier, in cases where a show cause notice was issued under Section 73, that is cases other than fraud or suppression of facts, no penalty could have been imposed if the tax and interest was paid within 30 days of the issuance of show cause notice. Now, under Section 74A, such time limit of 30 days has been extended to 60 days, which means that if a show cause notice is issued, say for financial year 24-25 onwards, and penalty has been proposed under a case which does not involve fraud or suppression of facts, then penalty shall be waived automatically if the basic demand and the applicable interest is paid within 60 days of issuance of show cause notice. So a similar timeline of 60 days has also been provided to cases where the GST authorities proposes to levy penalty in cases which involve fraud or suppression of facts. So practically from financial year 24-25 onwards, if penalty has been proposed under a case where allegation of fraud or suppression of facts has been made by the GST department, then penalty up to 25% shall only be levied in case tax and interest has been paid within 60 days of issuance of show cause notice, while at present such tax and penalty need to be paid within 30 days of the notice or order. So as per the proposed amendment, extra time limit of 30 days would be made available for payment of tax along with interest and penalty for conclusion of all the proceedings in respect of a particular show cause notice. So these were some important changes that have been proposed by the Section 74A. Thank you. And now Shanky would be discussing the key proposals under the Customs Act. Yeah.
Thank you, Sarthak, and thank you all the esteemed speakers for the wonderful explanation of all the budget changes. And I also wanted to thank the BRICS Chamber of Commerce for giving us the opportunity to deliberate on the budget proposals. I know that we are running behind the schedule, so not wasting much time. Let me just share my screen. I hope my screen is visible to everyone.
Yes.
Okay. So under customs, customs, as we all know, is a very old law. It is a settled law, so not many changes were expected. But in line with the trend of other laws, I think the government has come out with a number of changes, which are mostly in relation to facilitating the ease of doing business. Some of the changes actually may look very small, but may be very significant for some of the importers and exporters. So just jumping right into it, I think the first and most important change everyone knows is that most of the litigation which is happening under the customs is on account of the rules of origin. Now, this has become a very tricky issue. Most of the companies which are claiming the benefit under the FTA are made to submit a lot of documentation to justify that their claim of under the FTA is valid or not. We also know that the government of India is currently negotiating FTA with a number of trade partners, and most significant ones are UK and EU. And because of these controversies, I think there's a lot of pushback on the Indian government to relax the rules of origin. So one thing what they've done is that they have changed the Rule 20, Section 228DA, which enabled the carotar. Now, one of the significant changes which are there is that the rules now provide that the government of India, under the trade agreement, can accept any other proof other than certified origin as the proof of origin. So what it does is that it provides like a enabling provision both for the government of India and under a under the free trade agreement, to accept certain other forms of evidences as proof of origin. Although no changes have been done in the carotar. So, I mean, it will have to, we will have to wait as to how it plays out. But, so far it looks like a good measure, and, it will definitely, I think, will be very beneficial if under the future trade agreements, if some kind of beneficial regime is brought in, because a lot of trade bodies and the importers are suffering because of these stringent requirements. The other change is also a very interesting one. One is on the mower scheme. We all know that a lot of manufacturing is, especially the electronics manufacturing, is happening under mower scheme. An interesting controversy had arisen in this regard, wherein a solar power plant was set up inside the mover area, that is custom warehouse area, and the electricity was exported out of that area. The government, CBIC, came up with a circular in 2022 saying that the benefit will not be available for power plants, solar power plants, because you're just importing the capital goods and the activity does not amount to manufacture. The Delhi High Court set aside that circular, but what the government has done is that now they brought in the enabling provision, whereby what will happen is that they can prescribe any kind of activity which will not be eligible under the mover scheme. So I think this amendment has been done to counter the judgment of the Delhi High Court. I think overall it will not impact a lot of players here, but I think because it's a enabling provision, actually which kind of activities they will notify here will be something to watch out for. Currently, I think it will only impact the solar power manufacturers who are inside the mover area. Another change is that this is not very significant. One is that the government has removed Section 6 of the Customs Tariff Act. Section 6 of Customs Tariff Act was an enabling provision whereby the government could impose a protective duty to protect the domestic industry against any imports. Now, after 1991, to my knowledge, after the liberalization era, I think they have never imposed any goods with protective duty. So this was, in a way, a defunct provision. They have now gone ahead and removed it. One more change, which is also a trade facilitation change, is a change for the compensation cess. As you all know, SEZ, when it imports, it is exempt from the levy of IGST. A dispute had arisen whereby the GST authorities were saying, while the IGST is exempt, but compensation cess, which is not specifically exempt, should be paid by the taxpayer. This was litigated, and unfortunately, Andhra Pradesh High Court did come to a conclusion that in absence of any specific notification exempting the compensation cess, the SEZ authorities will have to continue to, SEZ units will have to continue paying compensation cess on the imported goods, though the GST is already exempt. Now, this was corrected sometime back, I think on 12th of July, whereby a notification was brought in under customs saying that compensation cess is exempt. But what they have basically done is that they have now made it a retrospective from 1st July 2017. So all the compensation cess, since the inception of GST, has been exempted. So no SEZ unit, even if it is liable to pay compensation or they have received a notice, they are not liable to pay any GST because this has been exempted from 1st July 2017 onwards. Now, last change is also a trade facilitation measure whereby reimportation of goods for repairs under warranty has been increased from 3 to 5 years, and re-import of goods exported for specifically for aircrafts and vessels shipping ships, etc., have been increased from 6 months to 1 year. So, these are basically some of the changes which were demanded by the industry, because 6 months period was deemed to be very less for these reimportation, and the warranty period, except most of the cases, would range for 1 year at least. So therefore, these are the trade facilitation measures could be very important for some of the industries. So these are the changes under the customs. I will just like to hand it over to Saurabh, who will take us through the customs tariff changes.
Thank you, Shanky. Quickly on the tariff changes, the theme has been more or less same compared to the previous years, which intend to support domestic manufacturing and promote exports and simplify the tariff structure. So the FM has also proposed to undertake a comprehensive review of rate structure over next 6 months to rationalize and simplify it for ease of trade, removal of duty inversion, and reduction of disputes. So in terms of key rate changes, rate of PVC flex is increased from 10 to 25% to curb the import of the same, considering the fact that it is non-biodegradable and hazardous to environment and health. Similarly, tariff rate for lab chemicals is increased from 10% to 150%, potentially raising the cost for scientific research and development. Coming to some critical minerals like lithium, graphite, and quartz, which are critical for sectors like nuclear energy, renewable, space, defense, and telecommunications, are either exempted or the rates are reduced to incentivize the processing and refining of such materials. Then, in the interest of consumers, the duty on mobile phone, mobile PCBA, and mobile charger is also reduced to 15%. To support again the energy transition, the list of exempted capital goods for use in manufacture of solar cells and panels is expanded. However, contrary to this, in view of sufficient domestic manufacturing capacity of solar glass, there is no extension of the existing exemption. Also, interestingly, in order to enhance the domestic value addition on gold and other precious metals, including silver and platinum, the custom duty on gold and silver is reduced to 6% from the existing 15%. So the effect of which we have already seen in last 2 days in massive drop in the gold rates. Next on the excise part, Shanky, if you can please. Yeah, on the excise part, there was a controversy regarding double taxation on the coal, which is lying in stock as on 30th of June 2017. So now it has been decided to end as a retrospective exemption, which has been provided for stock lying as on 30th June 2017 from levy of clean energy, clean environment cess. So that's a retrospective change for all of those who are having coal as a stock on June 30th, 2017. So that's all from customs point of view in terms of customs tariff, and maybe we can take up the questions if there are any. I think time what was allocated is already over. So yeah, if any question is there, maybe we can take up.
Dear participants, if you have any questions for our esteemed speakers, you can post your questions on the chat box that's on your screen, and then the speaker can take it up one by one. Thank you so much.
There is one question: how will the new tax policies affect individual taxpayer and businesses? So I hope this is for the direct tax.
Okay, no problem. Shall I address this issue?
Yeah, please, sir.
Yes, please.
We all know that the finance minister has already announced that they are going to rewrite the income tax law. Means there will be total revamp of the Income Tax Act here. Income Tax Act 1961 has seen lot of amendment, and each year amendment are being taken place here. Earlier, twice or thrice the attempt was there, but it was not succeeded, like direct tax code in 2010 and earlier when Arun Jaitley was their finance minister, there was a committee which was formed under the chairmanship of, I feel that Gris Ahuja was also the part of that committee also. That has not worked here. But government knows that the legacy of the Income Tax Act 1961, they are carrying, and they are carrying with lot of amendments here. That is not good here. If you see any of the provision, that is like 1023C, either in the 1023C, this is the 26th proviso that is there under the 1023C. So if the law is getting so complex here, then it is very difficult to implement it here. The government is trying to move that there should be a less deduction, less incentive here, and in order to move that less incentive, they are trying to offer, they are trying to encourage the new scheme of the taxation, particularly for the individual and HUF here, and individual HUF other than the company, and that is the 115 PAC, where you will be getting a higher slab rate here with a low tax rate here, and here you will not get any deduction here. Like in the case of salary, the standard deduction has been allowed from 50,000 rupees to 75,000, are for those who are under the new regime, not under the old regime here. Similarly, the pension fund is also for the purpose of new regime and the old regime for the purpose of new regime. So the new regime, which is trying to drive this income tax law, is like there will be less deduction and less exemptions here. So the question which was there here, that how the new tax practice affects the individual taxpayer and the businessman. Yes, the new tax practices is also affect the individual income tax. If you are a salaried employee, the government is encouraging you to come to the new regime. If you are under the business, so government is trying to say that wherever the loopholes were there, they have already been becoming sealed here. Like earlier, we know there was a loophole, big loophole was in the name of the goodwill. In the case of self-acquired goodwill, the person used to claim the depreciation, that has also been sealed off. In this case also, Section 37 was there. All these are the anti-avoidance measure that the government is taking here. Like income from the rental income, income from the rent of the house property. Earlier, the builder used to take in the income from house property. Now they are forced to take under the they used to take income from the house business profession. Now they will be taking under the income from the house property. So yes, what the government is doing here is moving towards two types of this ones. One is that deepening of the tax rate, deepening of the tax this one's here area where they can get some more tax revenue. And moreover, in the case of individual, they are saying that you have to come through the new regime of taxation. Like one of the very prominent example that I would like to give here. When we used to the CBDT person, they always tell me, Prakashji, why the individual salaried employee are giving so many donation under the 80G? Only the individual salaried employee are giving the donation, why the businessman is not giving the donation. So it is very well-known fact that under the 80G, the person who are giving the donation and taking the cash back here. So it is well known in the department. So they said, okay, I will curb the 80G. Similarly, HRA, a person is living in this parent's house and they are claiming the deduction of the HRA. Government say, oh, hold on. So I will curb this HRA. Similarly, many cases where the corporate has gifted the share to the other party. In the case of restructuring, the corporate has gifted the shares. They sold, okay. So under Section 47, they have said that only the individual and HUF can give the shares here. So these are the anti-avoidance measures that are being taken place, both in the case of the individual or salaried employee, as well as the business here. I hope that I have replied this question in a holistic way. If there is still something, I can reply that part.
Thank you so much for the answer,
Oh,
sir.
as an investor of a stock and mutual fund, what's from this budget here? I will tell you that if you are the mutual fund, you please hold the mutual fund units here if you want to earn the money here. And if these mutual funds are the equity linked mutual funds here, then you will get the 12 months for the purpose of long term, and the rate will be the 12.5%. However, there is no indexation here. But if you try to sell it before 1 year, it will be covered under the short term, and it will be taxed at the rate of 20%. Short mutual fund. So try to have the mutual fund which are the equity oriented. If you are debt oriented mutual fund, that will be treated as a if it is a debt oriented and listed here, then it will again you will get the benefit of the 12.5% and 12 months. If it is not listed, then you will have to wait for 24 months for the purpose of long-term capital gain. Oh, very good question, sir. This question is not directly related to the budget, but very limited. Do you think that you should both merge CBDT and CIC and for the better tax admission as opined by Dr. Parthiso a year ago in the talk? I will tell you. The suggestion of the Parthasarthi Som sir has not been accepted by the government. Parthasarthi Som has suggested in the case of 2012. He was appointed as the committee of the Tax Administration Reform Committee. And he was suggesting about that time, Vodafone was very critical part here. BIPS was very important here. He suggested that GAR and SAR should be there, and SAR should overrule the GAR here. But you can see the recent judgment of the Telangana High Court in the case of the Ayodhya. They have said that so Parthasarthi Som committee has not been accepted. And further, in the case of section 95 to 102, it starts from the notwithstanding anything containing any law here. So this means the GAR supersedes the SAR, and therefore the Ayodhya case from the Telangana High Court says that although the GAR and SAR can coexist together, but the SAR does not bar the implementation of the GAR. So that committee report of the Parthasarthi Som has not been accepted by the department, and this report was in the case of this report was formed in 2012 after the Vodafone matter when the finance minister was Parno Mukherjee. Anyone on this point here? Any question? As a consumer, what shift can we expect in the indexation and our purchasing power of these tax changes here? So the government has said that now there will be no indexation. So you can please don't expect any indexation. And recently, and day before yesterday, in fact, yesterday itself, a government has issued clarification on the issue of the capital gain. So it looks like that government is firm. There will be no more indexation under section 48. So do not expect any indexation here. As a consumer, what shift that we can, oh yes. So see that the government has already reduced the capital gain rate from 20% to 12.5%. So there should not be any quarrel on that part here. Thank you. I feel that I have tried.
Just to add, sir, even yesterday there was some clarification that even stamp duty expense is not, allowed as deduction. So your take on the same?
Look, what the law is trying to say. You see the direction of the law is that you claim the deduction of the cost part here. Whatever the cost of improvement part was there, I have taken care by reducing the rate from 20% to 12.5%. So government has analyzed how much the cost of improvement was there in the previous cases, how much the cost of indexation was there. And in order to claim wrong in cost of acquisition, many cases you have the house property, you have tried to create some value into this part here, and you have claimed certain cost of improvement here. We don't have the bill for the purpose of the repair and maintenance, but we have tried to claim the cost of improvement. In all cases, the notice has been issued under 147. So the government is saying that, yes, you have the cost of acquisition. You claim that cost of acquisition. I have reduced the capital gain rate, and this reduction of 7.5% takes care of your proposed whatever your cost of acquisition were there.
Okay.
So we have two more questions here.
Yeah, please.
Mr. Gowda has asked, do you think that an amendment in defining the term general public utility in defining charitable institution should be provided?
Look, that I will tell you very clearly. The Section 12 of the Income Tax Act, Section 12 of the 11, 12, 13 family of the Income Tax Act. And when the matter started under Section 2, subclause 15 about the GPU category, the famous case is the Ahmedabad Urban Trust here. Under this case, the government, the Supreme Court has said, larger bench has said that the 20%, the 20% of the income that will apply only for the purpose of GPU, not for the purpose of the per se charitable business here. Like if you are education, then the 20% slab will not apply. If you are for the purpose of the improvement of the monument, then the 20% will not apply. It will only apply for the purpose of general public utility. So these issues were there with the government here. And the government has, you can see from the last 2 or 3 years, government understanding is that they do not trust the trust. Government does not trust the trust here. So this year, what the government has said that hold, you have taken so many deductions under Section 1023C. They have said that now 1023C, there will be no deduction. It has been merged with the Section 12 here. So the 1023C goes into sunset clause here. So wherever there, I will tell you, please be very careful. Wherever there is any scope of reducing your tax liability, government will come with a full hammer here. The amendment is so much made under Section 11, 12, and so many restrictions has been created. Sometimes you will feel that it is better not to claim for the purpose of Section 12 restriction. It is better to claim without having the restriction here. So that is a very conscious call that the trust has to take here. And the compliance burden has increased here. 10B, 10A, 10B, 10BB. These are the forms that you have to submit prior to filing of the return. So these are the compliance, are very heavy compliance here. Very difficult to comply all these forms here. So unless we have the complete knowledge of all these forms here, I am suggesting my office here. So please be careful when you are filing the form 10B here. Yes. The question, shall I go to the next question, ma'am?
Sure,
Ishika?
sure, sir.
What is the next question?
Next question is by Mr. Boris. Hope this budget changes will not influence negatively on BRICS economic interaction. What is your opinion on this particular question?
Yes. What is the question? Just can you, what is the point here? Where the question is written here? Is the new bill amending PMLA Act? Okay.
Just before this, hope this budget changes will not influence negatively on BRICS economic interaction. What is your opinion on this particular question?
No. I will tell you. It is a very good budget for the purpose of the foreign company. It is a very good budget for the foreign company. There are two parts here. In the case of the foreign company, the rate has the corporate tax rate has been reduced from 40% to 35%. This means those foreign companies which have the permanent investment in India, they have the branch office in India, they will be taxed at a rate of 35%, not the 40%. The TP provision has been normalized for them. The second part is that one more part is that yes, in the case of the equalization levy, very much important. The equalization levy has gone away here. So it is the right time for the purpose of the foreign company to chip in Indian market. And the rate has been reduced. The equalization has been done away in order to catch the foreign investor for the purpose of invest in India. They know that they are competing with China here. So it is a very good time for the purpose of the foreign company to invest in India, particularly not for the purpose of tax rate here. The way the PLI scheme has been rolled over here, the PLI benefit is being given to many of the manufacturing units here right now. The scope of the PLI has been given here. So you will have the good benefit as for the purpose of the export-oriented part here. So good time for the purpose of the foreign company to invest in India. And I feel that it is a booming season for the purpose of BRICS here. You can invite a lot of member country to invest in India so that our speakers' business should also develop and my litigation practice should also develop here.
Thank you, sir. I think we are running out of time, so we can take the last question here and then we'll wind with this. With this, is the new bill in amending PMLA Act to hold CAs accountable for aiding in probable money laundering right according to you? And
look, I'm an advocate here, chartered accountant turned advocate here. So my reply will be a totally legal part here. And I can speak, no problem here. I can speak fast, I can speak a long time here. The purpose of the introducing the chartered accountant under the reporting part of the PMLA was there. It is not to catch the chartered accountant here. It is only for the purpose of reporting purpose here. And the chartered accountant has been treated as a reporting authority under the PMLA. Certain, I feel that is a section 47 of the PMLA Act, which where the amendment has been made. And in fact, the chartered accountant were. So what the government is trying to say that when a person is reporting something, that report should be verified or that report should be done by a CPA or the chartered accountant, because they are full aware of the numbers. They are masters in their numbers, and they can, if that is the part here, then they can reply that part here. So as far as the chartered accountants are there, they are not liable for the act done by the accused person under the PMLA. Please be remember, chartered accountant is merely submitting, merely a reporting authority, not the accused. PMLA is concerned with the accused MLA who are into the specified, who has done certain specified crime, and due to some specified crime, there are some proceeds of crime, and there is a proceeds of crime, and that has been laundered here. So please be careful about when we are reading the PMLA, that there is no responsibility for the chartered accountant. But there was a myth among the CA circle that now they which CA are liable. I will feel that CA are not liable. But one event that I feel that this is very bad here, that someone right now I came to understand, Archana ma'am was telling that the chartered accountant give the statement on behalf of their client before the GST authority. That is very dangerous here, because the recording of the statement is covered under the CPC Act and the CRPC Act, giving the, because you are under the investigation there. So the moment you will give the statement here, you will be personal, because in the statement, a person who is signing is a personally liable here. So you are giving the statement under an oath here. So my suggestion, as a personal suggestion to every chartered accountant friends, because I'm also a chartered accountant that please do not jump into the shoes of a client here, and do not go for the purpose of giving the statement. Even the client says you that you please give the statement on my behalf. This will create a big danger for you. And everyone knows the Gurgaon case.
Yes, sir. Thank you so much for clarifying what I also intended to speak up, because yes, I mean, the onus is going to be very large.
Don't, please, because the statement, the word statement is coming from the CPC and coming from the CRPC. So please don't read the GST law for this purpose. Read from where it has been derived here. Because what happened, the AO is a court under the Civil Procedure Code, CPC 1908. He is delegating the function of a court, and you are giving a statement before the court here. And that statement in under the oath here. So please be fine that you are giving a statement under the oath here. You are trying to jump into the shoes of a client here. I do not know how much client has paid you, but tomorrow some problem will come. The client will say, hey, I do not know anything. My statement has been given by my CPA. Difficult for you. So my personal advice to my all colleagues here, nothing else.
Thank you so much, sir.
Even we go to the court, we do not make the statement on our behalf. We merely try to make the statement on the client behalf.
Thank you so much, sir. I think with this, we come to the end of the session. I would like to thank all our esteemed speakers here. We have all this anticipation about the union budget every year, and you all take so much pain to go through the document. Of course, that's part of your career, but then again, to make them understand to everybody, for me personally, it's a very big task to actually understand what's going on. What is this all anticipation about? So easing that down for us and taking all this pain. Thank you so much for taking out time from your busy schedules and making us understand the nitty-gritties of the taxation part, indirect tax, taxes, GST, and whatnot. Thank you for your time here. I would like to thank all our participants who joined us today, and I hope you had a wonderful session. With this, we come to the conclusion, and with a wish that we'll come together next year and understand what's inside the budget 2025. Thank you so much, everyone.
Thank you, ma'am, and thank you all the learned co-speakers here. I have learned a lot here. Thank you, ma'am.
Thank you to all. Thank you.
Thank
See
you,
you all
everyone.
soon.